Yeah. Okay. Hello, everybody. And my name is Mike Wilkins. I'm the Executive Director and Professor of Practice at the Center for Climate Finance and Investment at Imperial College Business School. And I'm delighted to be hosting this first webinar in the series. And today's topic is the financial impact of climate risk. And it's the first in the three-part series, which has been sponsored by asset manager Unigestion. So climate change is sure to have broad impacts on companies across affected sectors, including on their credit profiles and share prices. But knowledge of this fact is limited, is of limited use to lenders and investors and regulators, unless the risk posed by climate can be granulated in terms of their scope, timing, and probability. So to discuss this topic, we have a number of people here joining us. So let me just, first of all, get the slides up. So I'm delighted to have with me here today Dr. Bob Buhr. So Bob is the lead author of the publication, which we're going to be discussing today, which is entitled, "What is Climate Risk? A Field Guide for Investors, Lenders and Regulators." So Bob will kick off the webinar with a series, with a summary of his research into what we are calling the climate risk taxonomy. And then we will have a response to his summary. And that response will be provided firstly by Carmen Nuzzo. Carmen is head of fixed income at the PRI. And then Carmen will be followed by Stella Mizoyan, who is an analyst at Unigestion. And both will be available also for the Q&A session that follows. So to ask a question during the webinar, please use the chat function. If you put your questions into the chat function, I will monitor those questions and I will pose them either to Bob, Carmen, or Stella as appropriate. And we will try and cover as many questions as we can. But before handing over to Bob to start off with his summary, I would like to invite Jerome Teleche, Managing Director and Head of Cross-Asset Solutions at Unigestion, to say a few introductory remarks.
Yep. Thank you, Mike. So just to give a little bit of background on Unigestion. Unigestion is a specialized asset manager managing roughly $22 billion primarily across dedicated product for institutions around the world, across 4 investment lines: equities, private equity, liquid alternative, and multi-asset. Going into the next slide, what I wanted to mention as well about our investment DNA. So we're very pleased to participate in this event with Imperial College. Research is one of the core pillars of Unigestion investment DNA. We have developed over time strong links with academia. And I would like to say that obviously climate risk and also anything related to ESG integration, which is very high across our range of strategy, is obviously very high in our research agenda. So we really look forward to that series of webinars on that topic that is very important for all of us as humans, but also as investors. And we hope to find some good ideas and roads to follow across our portfolios. So thank you.
Thanks very much, Jerome. And thanks to Unigestion for your support of this summer webinar series on climate finance. So now I'd like to ask Bob in around 15 minutes or so to introduce and summarize his report, "What is Climate Risk? A Field Guide for Investors, Lenders and Regulators." So over to you, Bob.
Okay. And should I just do this for the slides?
That's right.
Yes. Okay, I'm just going to, well, first of all, thanks for having me here and thanks for putting this on. This will hopefully be useful for the targeted audience, which is investors and lenders primarily. I will breeze through the first couple of slides. There's no point in talking about all of them. I just would point out a couple of things about why climate risks are tricky. And there's a couple of reasons for that. The first is that we haven't been here before. We have no track record on really any of these, possibly extreme weather, but that's about it. So in many respects, it's a brand new thing to be integrating into analysis. Although, as we'll see, many of the categories of climate risk actually draw from existing categories of risk analysis. The second is that, basic point is that we have an issue in terms of horizons. As Mike mentioned, there are three things you want to know about risk: likelihood, timing, and scale. What we have with climate is a set of risks where the likelihood is nearly certain. Sea level rise, for example, but what's uncertain is the timing and the scale, and this creates a complicated situation, especially in terms of what I like to think of as the horizon issue, which is that in financial markets, most of us basically have a 3 to 5 year time horizon, and we're talking about risks that may not manifest themselves for 10 or 15 years. How do we deal with that? Well, the way we have to deal with that, I think, is what the TCFD suggested, is some degree of scenario analysis. The point of this taxonomy is to sort of allow people, give people a toolkit for boxing out where are those risks that are going to have a financial impact likely to arise. And the final point to be made, and this can't be, I'll just skip on ahead here, is that this is geared directly at firms. Investors invest in firms. Lenders lend to firms. They don't lend to the chemical sector. So the analysis that's actually being proposed here, or the framework that's being proposed, is actually a firm-based framework. As we'll see, much of it is derivative of existing firm-based rating categories. The one other point to be made here is that these risks are not orthogonal. There are all sorts of feedback risks, or links across these risks that we know actually very little about, but we'll be learning that. And that also complicates things to some extent. Here's the basic model, and this is a model I put forward about 8 years ago when I wrote an ESG credit primer for bond investors. And the traditional risk there is what we all came out of. This is what we learned to do. And it's basically the rating agency model. It's an oversimplification, but it's actually turned out to be a very durable model over the decades. And the issue really is we got that middle box of climate risks, and the real issue is how are we going to integrate that into traditional risk frameworks? Well, that's a process, and there's no firm answer to that yet. But it's something that will need to happen as we move from perceiving climate risks as being idiosyncratic to being systemic, and that process is what's undergoing now. The natural capital risk category is basically a made-up one, but it seemed to me that there was a whole lot going on in the domain of natural capital, particularly relating to resource depletion, particularly water, that had a bearing on a lot of climate risks and where there was a lot of interaction between the two. So we will get to that in a second. So I'm going to go through the 4 basic categories and with some highlights. The way the taxonomy is set up is, we've got these general categories in physical of water stress, heat stress, et cetera. And then on the right-hand column, we've got the specific things that are likely to translate into financial risks if these things materialize. So it's basically a collection of theoretical risks. Some will arise for some industries, some will arise for others. I think it's reasonably complete, but over time, I'm sure it'll get modified. The thing about physical risks, which is worth mentioning, is that this is the area that's been covered most intensively by people who look at climate risk. It is actually very hard to pick up something allegedly talking about climate risks that goes above and beyond physical risks. It's a very well explored topic. The basic categories, I got 5, other people have 6, but it's all well understood. When we're talking about drought risk, whether or not it's a water risk or a heat risk, we're all talking about the same thing. And this is actually the bucket of risk that's actually been most intensively studied for fairly obvious reasons, because much of this, as I said, is certain. The sea level rise is going to happen. Extreme precipitation is going to increase. We know this. The issue is how to integrate that into financial impacts such as cash flows or operating margins or asset valuations. There's a whole, there's a basic list of 6 or 8 fundamental financial things that are likely to be affected here, because ultimately what you want to see is whether or not any of these are going to affect a company's probability of default. So I think that's all I'll say about physical risks. The next category is adaptation risk. I actually had a hard time convincing people that adaptation risk was a transition risk, but like mitigation, we're starting out at point A, which is where we are now. We want to get to point B. The problem is there's a lot of uncertainty as to what point B is. But these are basic categories that basically derive from the literature, in part because adaptation is so intimately tied in with physical risks, because that's what it is we're adapting to. There are broader issues of economic adaptation, but actually that's sort of secondary at the moment to what's going to happen in terms of basic adaptation strategies. Who's going to follow what strategy, and those are basically resist, accommodate, and retreat. The Federal Emergency Management Agency in the United States is now actually really pushing very hard for managed retreat. They are actually paying people to move away from the shoreline. This is not, they're not the only ones. There are lots of communities who are thinking of doing this themselves. It's going to cost a lot of money. And that's really sort of the issue for adaptation. Where are the funds going to come from? In many cases, it'll have to be the government. In some cases, they're just not going to happen. But what I've indicated on the right is where these things are likely to have an impact. I would say the one that's most likely to occur is stranded asset risk and insurance costs. Those seem to be the two that are going to be more likely to have a financial impact than the others. But I just want to comment on loss of subsidy risks. There are 2 risks that pervade this entire taxonomy. One is water and one is subsidies. And the problem with subsidies is everyone keeps promising to get rid of them, but they never do, which means as a result, we don't pay the true cost of energy, we don't pay the true cost of agriculture. And there's a variety of reasons why these subsidies are very resistant to being moved. But if to the extent that they can be, that's going to have material impacts, not on just the energy industry, for example, but everyone whose industrial processes involve heat, like the steel industry, the cement industry. So again, we see things are connected to each other in kind of interesting but problematic ways. The next transition category is mitigation risk. This is by far the most complicated. It's also the one that has the highest degree of contingency. If I were to pick one risk out of all these risks that was the major risk for firms, it's carbon pricing. But that's entirely contingent on public policy decisions on how we're actually going to do that. And at this point, we basically got 2 models, carbon tax or something like the ETS. And we don't know how that's going to play out. It's been wandering around for a couple of decades now, and I'm not sure we're that much closer to some sort of resolution on it. Other regulatory risks, some of these are longstanding. Greenhouse gas emissions go back a ways. Land use and zoning changes. There are actually a whole raft of non-carbon regulatory requirements that would be impacted by various climate regulations. These other categories are basically largely derivative, or at least technology risks and going concern risks are largely derivative of existing risk categories that you would find in, say, a Moody's or S&P guide to what they look at in terms of risks. The 2 that I would, the technology risks here are mainly associated with the energy transition, but there's all sorts of other ones, and everyone can think of some. The 2 going concern risks that I think are most interesting at the moment in terms of consumer preferences. You wouldn't think of consumer preferences as being a business risk above and beyond sort of normal events, but what we've got is 2 trends now, both climate related. One is meatless meat, which may or may not be a permanent solution to anything. The other is electric cars. Now, electric cars are interesting in a number of respects, one of which is that auto manufacturers need substantially fewer employees to assemble an electric car than they do to build an internal combustion generated car. So that in itself is going to be a risk for these companies. So that's an example of the kinds of risks that can arise from other things going on. Just a quick comment on litigation risks. this again is something where we haven't really been there before. We've seen two tracks of litigation, one directed against governments, which has been successful. The other is against individual companies, which hasn't been. I would just remind people, as someone who spent years following the tobacco industry spent decades not ever being convicted of anything. And then it just took one case to change that whole landscape. So I think that needs to be monitored. Water risks, I'll get to in a second, and again, lack of subsidy risks. The natural capital category is in a way the most interesting, but also the most fluid. This is entirely conjecture in terms of, is this the best way to look at these things? I know biodiversity is a hot topic right now, but actually the point of biodiversity is that's just one of a number of boundary condition risks that we are in the process of exceeding now, and they interact considerably with land use, with water use, with chemical use. So the notion that some of these can be picked out in isolation, I think, is misleading. If we're going to look at biodiversity, you have to look at other things as well. The main natural capital risk that's of concern is depletion. McKinsey put out a really interesting series of articles about 10 years ago in which they point out that the 20th century was actually the century of cheap commodities. That's history now. We're moving into more expensive commodities. It's not necessarily that we're running out of them. It's just that they're getting a lot more expensive to recover. And there are two general problems here. One is renewable resources. We are depleting them more rapidly than they're renewing, and obviously non-renewable resources we're depleting. So how, and there are industries for whom these are critical measures. Again, subsidy regime, and this, now many of these are actually probably more likely to affect sovereign profiles than individual firms. And it's hard to see any way around that. And the problem right now is it's easy to conjecture that some of these trends are going to get worse, particularly environmental migration, which has the potential, and I just threw in geopolitical event risk here. Again, not a derivative of climate impacts. So it's just basically, these are things that might ensue which are going to have less than positive outcomes. And I think that's pretty much a summary. I don't know if I kept within my time or not.
Right. Yeah, you did.
Oh, wow, that never happens. Okay, just a couple of conclusions were, we did do a little bit of scenario analysis with some of this stuff in terms of rating predictions in the European utility space. And it was suggestive that this might be a useful framework for pursuing that sort of analysis. But as we also noted in the stuff that we published on that, it's very independent and it needs a lot more work. The second is the categorization. I've made no attempt to map these categories onto the Basel framework. And this actually needs to be done, perhaps by some enterprising graduate student, I don't know. But the Basel framework is how banks allocate capital. And what you want is those decisions to reflect climate concerns. So how the two of those eventually will interact is an open question at this point. I suspect, like everything else, we're moving towards some sort of resolution there. Certainly the group of central banks, the Network for Greening the Financial System is pushing for that. There's 114 central banks in that now. So that's likely. Then there's standardization. Climate risk is in a way kind of a misleading term, but it's such a broad term that it's become embedded in our conversations and in our approach to, looking at climate impacts and looking at firms and looking at sectors, looking at government policy. The point that I tried to make in the report is that it's not a very useful term as a general term. You really have to granulate it down to more specific categories. Even if you're not looking at firms, but looking at a broader spectrum, there needs to be some granularity of the process. My example here is, I'm sure, Lord Stern is right when he goes around saying that climate change is going to take 3 points off of global GDP by the end of the century, or whatever the number is. the problem is if I'm a portfolio manager, that doesn't provide me any information in terms of whether or not I should sell my Saint-Gobain bond, for example. And that's really what this framework is hopefully, it's directed for, and hopefully will have some impact in that regard in terms of the decisions that lenders and portfolio managers and analysts actually make about, the status of firm X versus firm Y. And I think I'll let it go at that.
Okay, thank you very much, Bob. That's great overview. What I'd like to do now, if I may, is perhaps ask Carmen Nuzzo, who's head of fixed income at the PRI, to provide her response to your report and give her views on how climate risk is impacting financials.
Sure. Thank you. Thank you. First of all, let me say thank you for the invitation, and thank you to the CCFI and to Unigestion and to Bob, because this is a much needed piece by the financial sector industry. And I really do hope that this webinar is the first of many events that will help to disseminate the report and raise awareness about it, and most importantly, encourage people to use it. So very quickly, if you can turn, please, Mike, the slide to the one with the signatory base of the PRI. The next slide, please. That's perfect. Thank you. For those who do not know what the Principles for Responsible Investment is, we are the largest investor-led association which promotes the incorporation of environmental, social, and governance (ESG) factors in investment decisions. We do that through 6 principles. I will not list them all, but you can find them on our website, www.unpri.org. We count at the moment with nearly 5,000 signatories, of whom 76% are asset managers, 14% are asset owners, that is pension funds and insurance funds, and the rest is service providers. And these investors collectively, as of 2021, managed over $120 trillion. 50% were invested in equities, 40% in fixed income, and the rest was in real assets. So I'm the head of fixed income, as Mike said. I'll provide my perspective based on what I see on the ground with the interactions with our signatories. First of all, fixed income investors, let me say, who are always very concerned about downside risks, primarily credit risk, have been later than equity investors in incorporating ESG factors in investment decisions for a variety of reasons. The asset class is very complex compared to equities. There's been less research, both market and equity research, showing the links between ESG factors and returns, and also the lack of voting rights has been a barrier. But things have been changing quite fast since the middle of the last decade, I would say from 2015, which was really a key turning point from starting with the signing of the Paris Agreement and then the TCFD that Bob mentioned, and also very rapid regulatory changes happening in Europe with the Green Deal and all its related pieces of legislations and regulations, which are very much focused on green investing and geared towards green assets, whereas the piece that Bob has just published is very welcome because it helps also to frame the climate risks for companies that are not operating in the green sector and the brown. So some ESG factors have to an extent been always considered in traditional financial analysis, perhaps not labeled as such, but some are new, such as climate risk, as Bob was saying. And if you can turn, Mike, please, to the next slide. Fixed income investors approach responsible investing from different angles. So many are outcome driven. So they may invest thematically, or they want to target specific environmental or societal objectives. And in doing so, they might buy, for example, ESG label bonds, such as green bonds. But some investors focus on risk mitigation, including default risk. And this is why Bob's piece is very useful and timely. So these two approaches, the outcome-driven approach and the risk-return approach, are not mutually exclusive and may involve the same implementation practices. For example, at the PRI, we categorize them in 3 buckets: the integration that is purely focused on risk, the screening that effectively amounts to limiting portfolios based on norms, whether positive or negative, and then the thematic investing. But if anything, I would say the paper that Bob has presented today has the merit to highlight that when it comes to certain ESG factors, particularly climate change, the risk assessment is a prerequisite in the valuation of any type of bond, whether they're a thematic bond or mainstream bonds, because it helps really to uncover and unmask unpriced risks and assess them adequately and price them adequately, most importantly. So how investors incorporate these ESG factors varies a lot. One key factor is time horizon. So for example, for short-dated bonds or those that are not held until maturity, the time horizons associated to climate risks may be too short for ESG to materialize, for ESG risks to materialize, or for an outcome-driven approach to be relevant. But if you can turn to the next slide, please, Mike. When mapping ESG factors, including climate factors, it's important to distinguish factors by type. So an additional lens, perhaps to the nomenclature that Bob has presented, is to ask every time, is this factor event-driven, i.e. one-off, or is it linked to a trend, or is it policy-driven? So what type of factor is it? Will it impact just the issuer, or a single issue, or the whole portfolio? And furthermore, is it a macro factor, or is it a sector level factor, or is it a micro factor? And when it comes to time horizons, is it a risk that is present, or is it emerging, or is it potential? And when we talk about climate risks as long-term risks, this is true, but I think the events that we've witnessed in the last few years, especially those related to extreme weather, look at what has happened, for example, to Australia with the recurrent droughts and fires, or what the drought, which started in 2018 in South Africa, is doing to the tourist sector there and the food sector. These are not risks that are very far into the future. They're actually much closer than we think. So if you can turn quickly, Mike, to the next slide, please. I think it is important not to rank factors just by urgency, and it's important, sorry, to rank factors not just by urgency, but also severity. And I'm quite fond of heat maps because they help with that by dual dimension in the assessment of risk, but also heat maps, I found them very useful to track factors over time. So a factor may not be relevant now, but may become relevant in the future. And this could be a useful tool to help tracking the evolution of these risks. And it's something that we've been discussing at length during roundtables at the PRI. We've been organizing with analysts, credit rating agencies, and also more recently, the borrowers, the companies. So just to conclude, I really do hope, if you turn to the next slide, please, Mike, that Bob's paper will form more engaged conversations by investors with companies, and especially by fixed income investors for whom engagement doesn't perhaps come that naturally because of this lack of voting rights. And I see this as a toolkit that will enhance due diligence and will help unmask and price better risks, as I said earlier, but also have conversations with issuers about how prepared are they, how aware are they of these risks, and how prepared are they to mitigate them. And if I may conclude with just three very quick points. One is that you would see that many factors in the nomenclature and the taxonomy that Bob has presented appear different times under different categories. And this highlights the fact that there are interlinks between them, and these factors cannot be analyzed in isolation. But also we have to remember that climate is only one of many factors that investors take into account when they make investment decisions. So obviously this is very difficult. Number two, it's important to remember that these considerations apply not only to businesses, but also to sovereigns and local governments that are exposed to physical risk, as well as and they determine the policies that will lead us to the transition. So that will affect the environment in which businesses operate. So important not to neglect sovereign and sub-sovereign from the analysis. And finally, I really welcome the fact that Bob has included natural capital risks in the nomenclature, because it goes beyond pure climate risks. And this will encourage more focus on water resources and management, biodiversity, and land use going forward. So perhaps I'll stop there, and I'm happy to make more comments during the Q&A session. Thank you.
Thank you very much, Carmen. That's really helpful. And also I wanted to congratulate you and the PRI for all the efforts you've made to basically broaden everybody's understanding of ESG risks, especially in the fixed income world, in the credit world. I know from personal experience, having worked with you over the years, how much influence you've had in that respect. So well done.
Yeah, job not finished yet, but
No.
thank you, and thanks to the support of the credit rating agencies who've been extremely involved in all the work that we've been doing where you worked before taking this new hat, Mike.
Yeah, well, hopefully I can continue that Imperial from my days at S&P. So thank you again, Carmen. I appreciate your comments, and I'd like now to turn to Stella Basoyan from Unigestion. Stella is an ESG analyst there, and she'll provide her response to the paper. You're on mute, Stella.
Yes, I just unmuted myself. Hello, everyone. I'm Stella Mirzoyan. Very happy to be here. First of all, many thanks to Bob Buhr for pulling together this climate risk taxonomy. It is a great place for anyone to get started on their journey of tackling climate risk because of the way that it pulls all the relevant nomenclature together. So if we could go to the next slide.
Yeah, hang on. I assume that's your first slide.
That one, yes. So we are seeing recently that climate risk is moving from the niche of sustainable finance into the mainstream. And I would say that there are three forces behind this. So we have the increasing global impact of climate change, which is becoming increasingly difficult to overlook even in our day-to-day lives. So if we just look at the year 2020, it was actually the hottest on record. And there are a myriad of negative impacts of global warming on climate, ranging from ocean acidification and sea level rise to more frequent acute weather events like hurricanes. But the impact of global warming goes beyond just climate. It will also cause large-scale economic disruption. So we are also seeing changes in the regulatory landscape in response. So this is the second driving force, in my opinion. We are seeing binding disclosure requirements like the EU SFDR, non-binding recommendations on reporting like those of the TCFD, as well as frameworks like the EU Green Taxonomy being developed. The last driving force, I think, is investor preferences. Sustainable funds saw record inflows in 2021, so we're seeing that investors are becoming increasingly interested in green financial instruments, and they are also becoming more climate aware. If we go to the next slide. Thank you. So building on Bob's work, as well as my experience with analyzing climate risk, and more specifically, I have been involved in climate scenario analysis, specifically for equities and bonds. I would like to emphasize the unique challenges that climate risk poses and the ways that it is different from the usual traditional types of risks that we are used to looking at in finance. So I will try not to spend too much time on those that Bob has already mentioned. So firstly, as Bob clearly pointed out, there is no clear and universal classification for climate risks. Quoting from this paper, currently assessment of climate risks is more of an art than a science because of that. And on top of that, existing taxonomies often focus on opportunities rather than risks. That is true. That is the case with the EU Green Taxonomy that I've worked with as well. And then another issue is that a lot of within the existing frameworks, oftentimes you will see disagreements on how the different climate risks are classified. So as Bob noted, adaptation risks he considers as part of transition risk, but we will also see literature where adaptation risks are linked to physical risk. And the issue is that neither of the approaches are necessarily wrong. So a lot of the time, like in absence of a widely accepted methodology, you will find it difficult to navigate relevant information when you're trying to assess climate risk. And this brings me to the importance of understanding climate science language. And I think this is where Bob's taxonomy can help, because it pulls together all the jargon that you need to get started. So you can parse 20 pages of an IPCC report with more ease. Another thing that Bob noted as well is limited historical data. So I don't think I have much more to add on that. One thing that I would like to say is to speak about time horizons. So conventionally, climate risks need to be looked at much longer time horizon than what we're normally used to. So the convention would normally be until the end of the century, so to the year 2100, or at the very least 2050 or 2075. Now, the issue with that is that longer time horizons also mean greater outcome uncertainty. Even the predictions of climate scientists that far into the future are not fully certain. And with time, the predictions can change. So for instance, if our business as usual scenario, right, lasts for longer, then later on, 1.5 degree scenario will require much more serious action to mitigate and limit emissions. And this will look much different than if we were on a 1.5 degree pathway already. So I think this is important. Another thing to consider, especially when you're looking at assessing climate risks within the framework of climate scenario analysis, is the choice of scenario. So you have the usual ones like the representative concentration pathways of the IPCC, but there's also many other choices that you can go for. So there's always the questions of which ones do you pick? How do you assign probability to these different scenarios, and whether we as financial experts have sufficient expertise to assign probability to this scenario. So I think this is important as well. And then lastly, I think one assumption that we make when we do climate risk assessment that may not necessarily hold are certain stationarity assumptions. So for example, at firm level, if we look at the hospitality business, the hotel property, if it's in a coastal area, today, it might not be affected much by sea levels, so it might not be that sensitive, but say in 20 or 30 years, that the company would be much more sensitive. So this is one of the things that would change through time, but because of the long horizon of time of climate scenario analysis and climate risk assessments in general, a lot of the times you need to make these assumptions of stationarity that don't necessarily make sense. So. Right. Next, am I okay on time? Or...
Yes, you are. You can finish off. Yes, that's great.
Okay, so for my final remarks, I would like to reiterate the importance and the value of having centralized information for climate risk terminology. It is key to making this kind of analysis accessible to practitioners in the financial sector that aren't usually exposed to ESG or climate matters. Secondly, I think it is important to keep feasibility and scale in mind when we conduct climate risk assessments. With a granular firm level approach, this may be the best from the point of view of accuracy, but it becomes very difficult when you try to scale it up to very large portfolios, to very large equity portfolios. It can be, it can require a lot of work, and at the large scale, it may not be so feasible doing it at firm level. Is my remark. And then lastly, I think that the financial system can be seen as playing two main roles in the battle against climate change. So on one hand, we have the responsibility to be prepared for the adverse effects of global warming and the risks that it poses to the economy and financial markets. And this is where the climate taxonomy fits in. However, I think we should also be aware that our sector can support the transition to a low carbon economy via shifting capital flows. So via issuing sustainable financial products, we can shift capital to climate resilient activities and to finance technologies that can help us curtail emissions and reduce the impact of climate change. So while it's important to consider the risk side of things, I think it's also important to look at how we can improve the state of the world.
Great. Thank you very much, Stella, for those comments. And thanks also to Carmen for her insightful comments as well. What we're going to do now for the next 20 minutes or so is open this up to a Q&A session. Please continue to write your questions into the chat function. I see some of you already have, which is great. And we'll start off with those questions. And hopefully we'll get more coming through, and I'll try and get through as many as possible, either for Bob, Carmen, or for Stella. So just going to the first question that we received earlier on during the presentations. Well, first a couple of housekeeping things. Yes, the slides will be made available to all who attended this webinar after the event, as well as the recording. of the event as well. But let's go to the first real question, so to speak, and that's really from Patrick Bolton here at the Imperial College Business School, and that's related to the taxonomy, Bob. And Patrick's question is really, how does a taxonomy fit, or not, as the case may be, with the EU taxonomy? And secondly, he asks, what's the right climate horizon for climate stress tests? Is it 2, 5, or perhaps even 10 years, or something else?
Okay, both good questions. In terms of the EU taxonomy, I think it's very important to stress, actually, the point that Stella just made. The EU's taxonomy is a very specific attempt to steer investment. What they want is the energy transition to be funded. And they basically created a mechanism for helping investors do that. I think that's a great service. I think it's actually had significant impact. The taxonomy that I'm presenting is really aimed at doing something different. And I would say it's not a limitation of the EU taxonomy that it doesn't really deal with risk. It's just something different. Whereas what I'm specifically concerned about is how to capture the kinds of risks that are going to arise in a transition, be they mitigation risks, be they adaptation risks, or whatever. So I think it's important to keep that in mind. I think the EU taxonomy, and it's expanding now above and beyond green, and I think that that should continue. And I think it's going to. I mean, it's doing what they want it to do, but this is actually geared to a different set of problems.
Yeah.
Okay. In terms of scenario, again, Stella made this point: the farther out you go, the more uncertain you get. But we actually do have a situation where we have to look 10 years out. There's really, I'm not convinced that looking 2 years out actually buys us much. And there is a problem with 10 years out, in that the uncertainty level increases. But that's actually a reason for making sure that the testing that you're doing is covering all the bases. So it's good. I think the testing needs to get more complicated, and it will as the horizons get pushed out. But the point that I made at the beginning, climate risks, we have a situation where the certainty of occurrence is very high, but the timing and the scale is uncertain and actually contingent on a number of things. But that's exactly what scenario analysis allows us to do. And I think, if we're able to do 10 years reasonably well, that's great. Keep in mind, by the way, that everything we thought we knew about climate 10 years ago was wrong. It's coming faster, and it's coming with greater intensity than anyone predicted 10 years ago. So 10 years is actually probably the right horizon for a lot of this.
Okay, thank you. So another question has just come in. Do any of the speakers, including, of course, you, Bob, see that this taxonomy could spur firms into acting more aggressively in terms of how they address climate change? Do you think this taxonomy itself could actually act as a catalyst in a way to making changes?
Well, I'd like to think so, because I mean, the reason why I did this in the first place was comments from people mostly relating to the banking sector, but also relating to the investment sector, that there was a lot of uncertainty as what a climate risk actually was at the level of the reporting that firms were doing. This is true for banks, but it was also true for firms in general. And I think that's what actually stimulated the notion that what's needed is a taxonomy of risks that actually have the capability of materializing at the firm level. And I think hopefully this will make the whole assessment process easier. I mean, it's designed for assessment, really.
Right.
These aren't risks that are going to happen next year, or else you'd already be reporting about them. But if they're risks that are going to show up 10 years from now, this at least gives you a framework for saying, well, we've looked at a number of things. We think if there are going to be risks, this is where they're going to materialize, and this is what we're doing about it right now.
Yeah. Thank you. And just to point out to everybody that, as well as being on the CCFI's webpage, the resources for this event will also be available on the PRI's site as well. So, which brings me into bringing Carmen in. So I believe you had a comment you wanted to make on the taxonomy as well.
Yeah, I just wanted to add a couple of points to what Bob was saying in relation to the fact that the EU taxonomy is good for directing capital towards green activities and green investment. That's absolutely true. I alluded to this during my presentation. I think the piece of Bob is very important because it can help investors inform decisions also about companies and businesses that operate in the brown sector. If you remember during my presentation, I didn't use deliberately the word impact investing, but I refer to outcomes because we're very keen here at the PRI to educate investors about thinking of the consequences, of their investment, not just necessarily producing positive outcomes, but also helping companies in the transition towards more sustainable business models by reducing their negative contribution to the environment and the society. For example, the mining sector is a dirty sector, the chemical sector is a dirty sector, but we need raw materials, we need plastic, we need chemicals for the transition to low carbon economy. So not investing in these companies just because they're not green is not the right thing to do, but talking to these companies and understanding if they have plan to decarbonize, how aware are they about risks, how are they tackling them, are they prepared to face the costs of tackling them is extremely important. So that's it's a point worth emphasizing.
Yeah, thanks, Carmen. That's certainly a good point worth emphasizing. We just had a question come in earlier about how stock valuation models may evolve in relation to the new climate sort of approach to assessing risk, and could there be new climate metrics that will be built into these new models? Is that something that you have a view on, Bob?
Not a strong view. I'm a bond guy, so that lets me not answer the question. But I will say, how can it not? You know, for one basic reason, actually, this gets more to a natural capital reason than a climate reason. You know, markets for the last 40 years have been dominated by a number of basic models, none of which reflect resource limitations. And I think that's the main one that needs to be built in now. And I know there are people working on those sorts of things. I'm not sure they're actually working at them. I'm not sure those people are actually employed by major investment banks, but I know there is progress on that front. So I would say that's the major thing that really needs to be recalibrated.
Sure. Well, maybe turning to the credit side, there's another question that's come in around credit agreements. And do you think that the parameters around climate risk will be included in credit agreements? Maybe they already are, but this is kind of it's a way forward.
That's interesting and potentially troublesome because it depends on how those proceed. One of the questions I've gotten over the years, and I actually wondered about this for a long time, and then it's decided it was a really bad idea. And the idea was, let's put environmental covenants into deals. And if you think about that, at first it sounds like a good idea, but then immediately you think about, well, how's the trading desk going to handle this? If they think it's different. And this has always been my concern about green bonds, in the sense of trying to make them different from vanilla bonds, that as soon as traders figure out that they're different, then you run the risk of actually hurting the market that you're trying to help. And I think in terms of agreements, it really would depend on how issuers report more than anything else. I mean, one of the great things about the green bond framework is the reporting that companies agree to do. And I mean, I know lots of people worry about greenwashing in the green bond market. I mean, this is the most transparent market I can think of, frankly, in terms of companies saying what they're going to do and then reporting on it. So I think there needs to be, I mean, I think there's some need for that sort of consensus. I'm not sure what the best vehicle for it might be.
Yeah, okay. And please continue to keep your questions coming on the chat. Just as a follow-up to that question around credit agreements, there's another question related to the recently published prudential framework and role of environmental risk by the EBA, the European Banking Authority. So, which
I have not read.
You have not read. Okay, so I won't ask you to comment on that. I don't know if any of the other speakers have anything to say on that one. The question was basically comment on the role of environmental risk in prudential frameworks. So as you mentioned, the need for Basel, regulatory framework to incorporate this, and that hasn't been done yet. So perhaps there is an attempt now to try and move this forward through the EBA.
Well, Basel was interesting because they announced last year that they didn't see any real need to change anything in terms of climate issues right at the moment. And there was a lot of pushback on that. But if you think about it, everything that Basel, with that framework and the Basel pillars, it's basically geared to very short-term horizons. So it's and it's similar to the grief that you guys and Moody's got a couple of years ago for rating. Remember, the Moody's situation was rating some New Jersey municipal bond AA. And it was in the Jersey Shore, and everyone goes, "What are you, nuts? This is going to be, it's going to be underwater." And Moody's response was, "Well, it's a 2-year bond." So that's sort of that's part of the dilemma that the Basel people are in now. How is there a way for them to be able to accommodate longer term horizons? We always get back to the horizon issue, which is interesting.
Okay, let me just see what else is coming on the chat. One thing that's coming just now about countries, and I suppose how they address climate risk. The question is what all countries need to stress on this climate risk. I suppose just translating that, how do countries address stress testing? I mean, we talked about the firm level. What about the sovereign level?
I'm not sure about the stress testing because I'm not sure who actually is in a position to do it. The countries with the greatest degree of vulnerability would be the ones that you'd actually want to do it for. It's not clear that the resources are available outside of the World Bank and WRI, but I think you're right. It does. Some of this is very directly is translatable to a sovereign analysis. Not all of it clearly, but some of it is. And I'd say there's some real risks there.
Yeah, I don't know, Carmen, maybe bring you in on that one.
Yeah, actually, I was a bit fidgety because we've been doing quite a lot of work in the sovereign space as well as the corporate space. I would say, first of all, flag the fact that the World Bank is doing quite a lot of work from an educational perspective through their Treasury office and other departments with their members, particularly emerging markets. But also we at the PRI were supporting an initiative called ASCOR, Assessing Climate-Related Sovereign Climate-Related Risks and Opportunities, whereby we're trying to put together a tool that would be a public good, freely available, to try and assess sovereigns both from a physical perspective, a physical risk perspective, and also from a transition perspective. So it's work in progress. We will also look at the funding needs of sovereigns depending on their exposure to these risks, but it's something that we plan to start publishing as of next year if things go according to plan. So watch this space because there is nothing at the moment for sovereigns. There's no TCFD for sovereigns, for example. There is very little to be done in the space. And I think, considering the size of the asset class, particularly in fixed income portfolios, much more attention should be given to this area. So do watch our webpage for additional resources and information on this. And I also wanted to add one more point because I've seen another question, if I may preempt it, on what is the role of bank towards green transition. Very important role. We are doing work with banks in collaboration with the UNEP-FI because they have actually quite a lot of power, if you will, in assessing green credentials when they issue loans, they originate loans. And so that's the questions that they ask and in the green criteria that they take into account when they disperse loans is quite important. Data availability is still a barrier, as it is for most of the responsible investment world, but many banks have started to make progress in this area. It's not enough, but some have started. And also it's an important area for securitized products because these loans then get repackaged in securitized products that give access to credit to small and medium-sized companies. And we're seeing many products coming to the market with a green label, and it's not clear whether they're actually very green. So investors have are dubious about the veracity of these instruments, and we're beginning to do more work in this area as well. But banks have a very important role to play, just to say that. Thanks.
Yeah, absolutely.
Can I add something?
Yeah,
Yeah, which
quickly.
is in thinking about sovereigns, there is one space, one area where there's actually a fair amount of information, and that's national adaptation plans. Under Paris, everybody who's a Paris signatory has agreed to put together a national adaptation plan, which by definition is going to include a government's or someone's assessment of what the climate risks for that country actually are.
Yeah.
And actually there's been a whole lot of them published. I think there's something like 100 and something plans in being worked on. The UK's is now in its second iteration, for example.
Yeah.
And the World Bank has a number of reports on this, and individual countries have their own reports on what is it that we're going to be dealing with, what sort of resilience outcome do we want, and how do we get there?
Yeah.
So there is a growing literature on that issue, I think.
Yeah.
Now, that would be where I would start on this,
Yeah.
frankly.
And we're actually doing quite a bit of work at the Center for Climate Finance and Investment on sovereign climate risk and the impact on credit quality. So there'll be more to come from us on that one as well. So I'm conscious that we haven't given Stella much chance to answer anything yet. So there's a question that's come in, which is tailor-made for you, Stella. And it says, should portfolio managers and other non-bank financial institutions start stress testing climate and ESG related risks? And if the right tools and resources are available to do so. Have you got any views on that?
Absolutely. You should absolutely do climate stress testing at portfolio level. We've done it as well. So when I was speaking of climate scenario analysis, that's the work that we have been doing. Now, back when we started doing it, the data is there. It is not necessarily publicly available, but it is there to purchase. Now, recently, a lot more data has been coming along that is publicly available that you can use for climate stress testing. Like I think of over the past 2 years from the World Bank, there is a large platform where you can find all sorts of different climate metrics that are available, the forecast under different climate scenarios, the RCPs, you can find precipitation, you can find temperature, all sorts of metrics that you can use in your models. So it's definitely possible.
Sure.
It's possible to do, and you just need to find some kind of way of linking those forecasts of the different climate metrics to something tangible that you can link to an existing financial risk metric. So those are generally the kinds of approaches that are used both in literature and in practice, linking forecasts of some kind of relevant climate variables under different climate scenarios and linking them to an existing financial risk metric. That's how I would say it should be done.
If I may add to that, I mean, even our risk department now is stress testing our portfolio on a daily basis on the basis of this type of models.
Sure. Great. Thanks, Stella. Thanks, Jerome. I think we'll have to stop there. I mean, I know there's more questions are coming in, which is great. More questions.
Send them to us.
We'll attempt to answer them afterwards as much as we can. Thank you for coming and also for all your questions. And thanks also to Carmen and to Stella, to Jerome, Unigestion as well, and of course to Bob. I would like to basically just say that if you want a copy of the report that Bob's been alluding to called What is Climate Risk? A Field Guide for Investors, Lenders and Regulators, that's available on the CCFI website. The second in our summer series of climate finance webinars will take place on Monday, the 30th of May at 3 p.m. British summertime. The topic is going to be achieving net zero, crossing views from academia, index and active investing. And that will be led by our own Professor Patrick Bolton from the Finance Department here at the Business School, and also our Academic Research Director at the Centre. And there will be responses from a representative from S&P Dow Jones Indices, and also somebody from Unigestion as well. So we'll have a similar format for that webinar. That's on the 30th of May in about 2 weeks' time. So be sure to sign up and tune in for that webinar in a few weeks' time. But for now, I just wanted to sort of close out by saying thank you very much for attending. Thanks again to all our speakers for their insightful remarks, and I wish you a great rest of the day and week, and goodbye for now.
Thanks for having us.
Thank
Thank
you.
you.